Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. Do me a quick favor, if you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. Our next investor conference is less than 3 months away. The Planet MicroCap Showcase Vancouver is coming up on September 6th and 7th, 2023 at the Fairmont Waterfront. Be sure to check out a recent episode with Paul Andriola, founder of Small Cap Discoveries and lead sponsor of our event, to learn more. To register and attend, please go to planetmicrocapshowcase.com. See you in Vancouver. Now, my guest on the show today is Paul Dwyer, Director of Research at Punch & Associates. I recently had Paul's colleague, Howard Punch, on the show, and after recording, Howard asked if we had ever done anything on the Russell Rebalance. After spending a few minutes in the deep Planet MicroCap podcast archives, it turns out we hadn't. So I acted on Howard's suggestion and invited his director of research to talk about it. We recorded this interview on Wednesday, June 21st, 2023, and the Russell Rebalance officially takes effect on Monday, June 26th, 2023. So the timing couldn't be better for this one. Thank you again for tuning in to the Planet MicroCap podcast, and please enjoy my conversation with Paul Dwyer. Paul, thank you for joining me today. How are you doing?
Good, Bobby. Thank you for having me. It's great to be here.
Absolutely. It's great to have you. Look, when I just interviewed one of your colleagues, Howard Punch, I guess that was about a month ago. Yep. And, when we got done, we were talking about, hey, have you thought about doing an episode about the Russell Rebalance that's coming up? And, the dingleberry that I am can't believe I've never done one, talking about the Russell Rebalance, not just for obviously the Russell 2000, which is the main small microcap benchmark, but just in general for folks that aren't aware of what's happening, what takes place on an annual basis. So here we are. We're doing a full episode on the Russell Rebalance. So, let's start there. For those that aren't aware of what this means and how this affects the stock market, all that good stuff. Paul, can you start us off? What exactly is the Russell Rebalance and how should we think about it?
Yeah, you bet. Thanks again for having us, for having me. It's great to be here. So big picture, the U.S. Russell indexes rebalance at the end of June annually. What we're talking about today is largely the Russell 2000 index, which is focused on, that's the small cap benchmark focused on companies kind of 1001 to the 3,000th largest company out there that's eligible from a U.S. perspective. Companies, the indexes start to figure out what is going to be added or subtracted from the indexes towards the end of April. And then May is kind of a positioning month. And then at the end of June, they tend to kick out about 10 to 15% of those 2,000 companies each year, just based on market performance overall, what sort of companies have raised capital, companies have been acquired, et cetera. And so, what we focus on as kind of microcap investors is that 3,000th company. Like, what is the last company to get into the index? And that can be a big driver of investor attention to that last company. And so, this year, for example, that market cap is about 160 million. So that will come Friday, June 23rd is the rebalance day this year. tends to be towards the end of June every year. And so there'll be about 168 companies getting booted and 190 companies getting added to the Russell 2000 this year. And that's kind of the pond that we like to look at for new ideas, is those kickouts, and hopefully own a couple of the 192 companies that are getting kicked in and benefit from some new investor attention.
Absolutely. So, okay, let's dig in a little bit. And it's funny you mentioned the market cap, but the name of the company is publicly out there as well. So if you wanted to check it out, I'll say it is Protolix Biotherapeutics. I'm not a shareholder, but that is.
Yeah, nor are we.
Yeah, and that is the smallest one that's out there. But let's think about this a little bit more, because in terms of strategy, not saying that this is part of your strategy itself, but you start to see the announcements trickle out from individual companies, set to join Russell 2000, set to join Russell 3000, in that June-ish, May timeframe, and that's a pretty big news announcement for most of these companies. Right now, you're going to be on an index, you're going to get all sorts of new action inflows. So, I mean, when you think about it from a strategy perspective, again, not yours in particular, but maybe for folks thinking about it, I mean, isn't that already somewhat priced in many respects? Because a good amount of these companies are using this as like, hey, this is a newsy event. We want our shareholders to know.
Yeah, no, that's a good point. I would, we tackle the rebalance from two different angles. Kind of what you're talking about in terms of market performance. From what we've seen, the market performance definitely happens before rebalance date. So we start to see movements in companies that are expected to be added and expected to be kicked out, as early as 6 months prior to the rebalance. So we're starting to see some, let's call it non-fundamental moves going on in some of these stock prices, as early as January of leading up to the performance. And then, it's pretty dramatic. Companies that, the studies that we've done kind of internally, companies that are getting kicked in can outperform by about 20% relative to the Russell 2000 over that same period. And companies that get kicked out, it's I think they're down about 35% relative to how the index performs itself. So there's definitely a lot of trading that's going on up to the rebalance date, getting ready for the reconstitution of the index. And then, in terms of what happens the day of, that's we don't see as much stock market movement going on the day of. By Friday, June 23rd, most of the movements in these stocks should have occurred one way or another. But where it can be an opportunity is, if there's a company that you want to get a bigger stake in, there is going to be a lot of trading volume going on that day. So, we owned a company back in 2019 where we had a small stake, wanted to make it a bigger stake. It was trading like 25,000 shares a day, which, is okay for a microcap in terms of volume. It's not just by appointment only, but on the rebalance date, it traded 900,000 shares. And so you do see these like 10, 20, 30x volume relative to the normal trading volume that you see on a daily basis. And that could be an opportunity, whether you want to get rid of a stock that was less liquid and it's for whatever fundamental reason you want to move on, or a company that you want to add to it, it's a good opportunity.
Absolutely. I mean, do you also use it for idea generation as well? I mean, obviously now there's going to be a bit more liquidity for sure. But now you're going to see some companies in there that weren't in there before. Now there's going to be that extra liquidity. There's a reason for why they're included, right? So I'd like to hear your opinion there.
Yeah, our general philosophy is that opportunities are greatest where capital is most scarce. And so, what we're really looking for are those companies that aren't in the index yet, and that if they perform based on our expectations, we'll largely see the earnings power that we expect to come out of it, and we'll see a few years of earnings growth. And then as they get added into the index, we should hopefully benefit from the extra 1.6 trillion that's benchmarked to the Russell 2000, and there should be some multiple expansion on top of just hopefully a company getting better over time. We do look at all the kickouts as well for idea generation. So, we're running weekly screens kind of as early as January based on what we think the kickout line might be, and starting to look at companies that we expect to fall out of it. A couple points I'd make there is that in our mind, fundamentals still matter. So, just because a company got booted out of the Russell doesn't make it a good investment by any means. Some of these companies deserve to get kicked out, and so you can't just buy the bucket and a basket of companies that do get removed. And then there does take some time, particularly for kickouts, before they start working again. So I think if you looked at the study, it would take another 3 to 6 months, even after the kickout, for those companies that did get kicked out to kind of keep up with the Russell. So you've got time, but it is definitely a source of idea generation for us. Just to go through that list, we kind of think about it as just another tool in the toolkit in terms of, we like to look at all spinouts. We like to look at tax loss harvesting candidates. We like to look at broken IPOs. And I would include Russell 2000 kickout candidates as another interesting pond to fish in for microcap ideas.
Absolutely. So I know that the criteria for inclusion, we could probably do an hour just on all of that. But, I guess for the Cliff Notes version, for those that don't know, what are some of the criteria for inclusion in Russell 2000, 3000?
Yeah, you're right. You can go to the Russell website and they'll give you a 45-page deck on all the rules.
Like I said, I don't think an hour would be enough, actually.
Yeah. The main ones that we pay attention to in terms of any company of ours that might not ever be able to get kicked in is it's got to be a listed and headquartered in the United States company. It's got to have a price per share over $1, and both the float, meaning the kind of the publicly available shares that can be traded, as well as voting rights, both have to be above 5% of the overall. And so, you check those 3 boxes, there should be a pretty good chance that you're included in the index. They do exclude things like business development companies. So those are not allowed to be in the index.
Very good. Yeah, just looking at some of the data for this rebalance, we're seeing, total market capitalization of the Russell 2000 index decreased 10% from 3 trillion to last year's reconstitution of 2.7 trillion. From 3 trillion to 2.7. How the largest company in the index is a 6.3% decrease from last year's largest company. The smallest company is a 33.6% decrease from the smallest company in the index last year. It's pretty interesting data to sift through when you're thinking about like the love of the small microcap community for the last, 12 months, I guess you'd say, using this. But what are your thoughts on some of this data?
Yeah, no, I agree. It is big market moves that can happen to these small little companies. And, I think one of the most interesting quirks is that the Russell 2000 cutoff doesn't always match kind of what the Russell 2000 performance is the year before. And so that can create some really big moves about companies that are in and out that don't have a lot to do with fundamentals. And, specifically what I'm talking about is, the last, obviously 3 or 4 years have been pretty wild in the marketplace. And, 2020 and 2021 in particular had a lot of capital markets activity. And so as you're floating new companies into the public domain, that can bump out some somewhat decent companies that haven't really underperformed anything in the benchmark, but that they just get booted out of that 3,000 level of the company, right? There's only 2,000 spots. And so if you add 50, 100, 150 companies through the SPAC markets, through companies raising capital through traditional follow-ons, et cetera, some good small companies just don't make the cut. And that could be an interesting opportunity. So like in 2020, the Russell 2000 fell about 13% for the prior year, and the cutoff fell 38%. So we saw a decent amount of like high quality companies actually get added to the Russell 2000 benchmark that year. In 2021 and 2022, the cutoff jumped a lot higher than the stock market performed because of those SPAC companies that went public and just all the capital markets activity that we saw. And so then there was a lot of companies that, pretty good companies that got booted that, even if you kept up with the index in terms of performance, you might not make it. And then you're just getting a lot of non-fundamental selling pressure. And then this year it's kind of the opposite. Obviously, as some of those more speculative companies that came to market over the last few years have had a tougher bear market here. The cutoff is falling about 35% relative to the index being about flat. And so that has, what we're seeing in our portfolio is a lot of companies that got the boot in 2021, 2022 are starting to get added again. And so that can create a lot of trading opportunities around companies that you like. And, we try to be long-term 3, 5, 10-year shareholders of these companies. But, as you know, in microcaps, you can't just sit on your hands and you've got to trade around positions to optimize performance sometimes.
100%. And what's interesting? I mean, the turnover is not that crazy, right? I mean, look, so it's about 15% new names going into the Russell 2000. It's interesting seeing it looks like healthcare kind of led the way in terms of new of that 297, 81, or I guess that's 81 from the Russell MicroCap, I guess, went up into there. So that's kind of interesting, especially since biotech's just been absolutely hated for, for at least the beginning part of the year.
It is. Just the benchmarks and the weightings are interesting to watch in general. And I think to your point, healthcare is going to get the biggest boost to the index this year going forward, and then I think consumer discretionary is getting the biggest pullback in terms of companies. And so, that as people that like to turn over rocks nonstop, that kind of makes us think, oh, maybe there's a couple interesting consumer discretionary companies that may have gotten the bump unwarranted, or I'm not quite sure what went on with healthcare in the last 12 months. If there's some extra capital raising to push it forward, or if those companies have just started to recover from what was a really challenging, obviously, 2022 for a lot of them.
Absolutely. I mean, just based on some of the data that you've seen so far for, this annual rebalance of all these indices, I mean, what stood out to you the most?
Yeah, I think I would go back to what I was talking about in terms of the benchmark has fallen dramatically relative to where it was the year before. And so we have seen some companies that I would not have expected to get into the Russell yet jump in. So, the cutoff went from 240 million in 2022 to 160 million in 2023. All of a sudden, some of our companies that were at 100 million market cap, 125 million market cap, and put up a good quarter or two of earnings have seen really strong performance over the last 6 months here as they kind of get bid up by non-fundamental buyers as they kind of approached closer and closer to that 160 million market cap, and that kind of becomes a self-fulfilling prophecy that eventually these guys get bumped in.
For sure. Do you think there must be? I mean, there obviously is one. I've actually talked to some management teams that think about this, but there's definitely a strategy from some of these microcap management perspective of like, hey, all right, beginning of the year, we want to be eligible for the Russell. Like that'll help us with quite a few things, like especially if they want to raise capital, especially right now, because a lot of them missed the boat, when things were skyrocketing in 2021. So there's definitely a strategy right now where a lot of these companies are probably like, hey, like, let's cut costs, like let's show profitability, let's get the trading up, let's get the story out there, blah, 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 so that we can at least be eligible, get in the Russell, and then, do some of the other corporate actions that we've been trying to do. I'm sure you've had a few of those conversations over the years.
Yeah, you're spot on, and it's probably no surprise as passive versus active has been a bigger and bigger discussion in investing over the last 3 or 4 years. When I started investing 7, 10, 15 years ago, there wasn't many microcap investors or microcap CEOs, where they would talk to me about the Russell Rebalance and what the cutoff level is going to be. And now pretty much any microcap company that we talk with in that, call it 100 to 300 million market cap band, it is on their mind. And it's, it's probably, it's kind of like everyone knows.
It's prudent.
It is prudent. No, that's fair. That is fair. If someone asked me about it, it's don't go raise equity just to get yourself included into the benchmark. You're going to lose a lot of existing shareholders if you just go raise equity to attract some other shareholders. But you cannot blame someone that says now is a good time to really get out there and tell the story. I think I'm 10, 15% stock price movement away from being that 3,000th company. Let's get after it. Maybe do one or two more roadshows.
It only makes sense. And you know what? These are all companies just trying to make it. They probably good amount of them will need that extra growth capital. Do what you got to do. As long as you're kind of open about it, that makes it a little bit more palatable for those that want to be or believe in the story and believe in what your objectives are for in that 3 to 5 year time horizon. It would suck if they got you to believe that and you have that time horizon, and then here they go. I mean,
right. Well, I mean that's
the part that sucks.
Yeah, at the end of the day, fundamentals matter, right? And so it does you no good to get a one-time pop over promise, and then you get booted 12 months later, and you kind of just become a stock that gets buried. I mean, what we're really looking for is like, who is that 125 million, 150 million market cap company with a CEO that can grow this thing to 300 million, and you just benefit from a little extra multiple expansion along the way, on top of just owning a good business. That's obviously what you want to do. And then what like I talked about earlier, what you don't want to do is just buy all the stuff that got kicked out. We've made the mistake of owning things like newspapers that get bumped out of the Russell 2000, and lo and behold, newspaper is still not a good business, and there really wasn't a great price that you should ever have paid for it. And so we've certainly had our mistakes chasing the companies that get kicked out, but it's kind of like anything. It's an ideal list.
For sure. All right, let's look at some of the industries and the industry weighting. So I'm seeing here the largest industry for Russell 2000 remains industrials at 17.7%, increasing slightly from 17.5%. Healthcare number 2 at 17.4%, and then financials 14.2%. And the largest increase was in technology, going from 10.6% to 11.8%. And you're right on it, right? The largest decrease was consumer discretionary, going from 13.9 to 13.3. Love to hear your take here. I mean, you already kind of talked about consumer discretionary. That made the most sense. We talked about healthcare a little bit, but industrials now, for the second year in a row, or maybe more than the second year in a row, but also now increasing in terms of weighting. So, let's get your take.
Yeah. I mean, I think a lot of that is just tied to industrials. It's just such a catch-all bucket, and I think it probably got bumped up a little bit with people getting excited about infrastructure spending and kind of seeing some of the capital dollars that have come out there, just bumping up a few of those companies. I don't have a lot of insights other than that in terms of why industrials led, other than the outlook for industrials probably is encouraging for a lot of people, and they started cheap as well. We own a fair amount of industrials ourselves, and there's a lot of companies that are trading at high single digit, low double digit earnings multiples, and have had pretty good cash flow generation over the last few years, and I think as the cost of capital has gotten a little bit higher, that has probably helped those well-capitalized, lower earnings companies hang in there maybe a little bit more relative to some of these companies that, consumer discretionary just is worried about kind of people moving from buying of things to buying of services, and what the implications are for any economic slowdown has certainly weighed on some of our own consumer discretionary companies, I know. Healthcare, we talked about a little bit just in terms of there's certainly been a bit of a reset of expectations in terms of multiples. And I think industrials just might be that somewhat boring catch-all bucket that just hung in there maybe a little bit better than others in 2022, thanks to maybe a slightly lower bar to step over to begin the year.
Absolutely. So I'm also going through you sent me a great presentation with some nice charts, kind of comparing to year over year, also relative performance, total relative return prior to rank day. That hits exactly what you're saying now. Like usually it's most of the action happens about 3 to 6 months before the actual rank day. It's like literally it's just flat straight up like a week before.
Yeah. I mean, it's we start seeing.
We're also holiday season, right? Like it's
yeah, volumes are, we start seeing people throwing out estimates for what the cutoff could be as early as the September, October year before timeframe. And so there is a lot of guessing and speculation in late Q4, early Q1, and the first half of Q2. And at this point, end of April is rank day, so they draw the line there. And so the first few lists of who's included and who's not included becomes public information in May. Russell publishes those lists. And so at this point, it's just moving volume around from some active shareholders to passive shareholders and other trading going on. So the moves have all happened. But like I said, it does take a while, certainly for the kick outs to recover. So you do have time after this June 23rd date to look through all those kick outs and do the work and figure out if there's anything interesting there. And then go from there.
Yeah, we're lucky the turnover isn't that crazy. So it's like, okay, I only have 100. How many is it?
Yeah, I mean, still got to sort through 150, 200 companies. So
yeah, not too bad.
That should keep you. It keeps us plenty busy, anyways. On top of all the other opportunities out there. So, like I said, I really think it's a really interesting opportunity set that's predictable in terms of, look, every January we start making a new list and start sorting through it, and it's a bit more predictable, but it's also it's hard to actually call what the cutoff level is going to be because of acquisitions and capital raising activity, et cetera. You can't just say, well, I think the market goes up 8 to 12% a year, so if it's at 160 this year, it should be at 175 to 180 next year. That's just not how it works, and so it does keep it. For people like ourselves, exciting in terms of what's going to happen.
Hey, speaking of that cutoff level, I mean, for those, the Rebalance for Dummies book, how do we know what the cutoff will be every year?
Yeah, it's a great question. It, in my mind, is hard. Like we don't do it ourselves, is the short answer. And there are people that spend a lot more time than us going through and saying, okay, who are the companies that have been kicked out? Who are the companies that have raised enough capital and are just constantly looking at what is that 3,000 company? So we'll start getting estimates from some of the sell side community in Q4, and they just are running that quant screen and go from there. So that's kind of the best I can say is if you really want to do the work, you can just pull the top 3,500 companies out there that are publicly listed and meet the exchange and sort rank the list yourself to get to that level. There are some people that will send out the data from the sell side, and realistically, we're using it as just a bit of a benchmark because it's a moving target and no one knows exactly what's going to happen, right? So like you go through March of 2020 and any estimates that people had made in December of 2019 are totally out the door. And it's just which of your companies have hung in there better than others in the middle of a pandemic. And so hard to build a quant model trying to front run it too well, and it's more just in our mind starts creating an opportunity set, but you still got to like the company from a fundamental perspective.
100%. So, I mean, in terms of risk, what would you say are some of the biggest risks for an investor that are interested in, having some sort of Russell Rebalance strategy or looking a little bit deeper into the mechanics of this?
Yeah. I mean, I think the biggest risk is you get tricked from this stock got cheap, and so it must be a good investment. The last 3 years aside, the cutoff and the market and the stock market movements have been a little bit tighter. So companies that fall out of favor tend to fall out for fundamental reasons. And so you can't just say, I got kicked out of the Russell. It must be a good investment, and it'll just turn itself around, and a year later I'll get kicked back and it's good to go. The other thing that you got to watch out for is, we'll take the opportunity, like I talked about, in terms of buying companies that are getting added to the Russell that we like. But investors are wrong occasionally, and if we were able to get into the position because of the liquidity that was provided during the reconstitution and the rebalance, and then volume does go back relatively to normal, maybe slightly above what it was in pre being in the index, but certainly not the same sort of 10x volume. You can be buried in a name that you were wrong about, and that can certainly be a challenge for an institutional investor like ourselves, because we'll certainly be wrong on some of these companies that we buy, and then you've got then our traders got a much harder job in terms of trying to get our way out of it. It's much more fun and easy if you're had a great winner that you can sell into the kick out or the kick in, relative to buying something for the first time at the kick in, realizing you're wrong, and then there's no volume to get out of it. So I think the volume goes away, and not being fooled just by a movement in the stock price would probably be the two biggest risks.
For sure. I mean, when you talk about like looking at some of the stuff that's been kicked out, I mean, are you saying that you look at stuff that's been kicked out of all Russell indices completely, or are you looking more of like, okay, it fell from the 1,000 to 2,000. Oh, it fell from the 2,000, the microcap. How do you think about that?
We will look a lot at stuff that goes from the 2,000 into the microcap, because there's a lot less money benchmarked to the microcap index than there is the 2,000, and so you do see pretty good moves of there's less people paying attention to companies in the microcap space relative to the small cap space, and so those create the opportunities. I mean, we are happy to look at companies that aren't in any index, but you start to get pretty small at the bottom end of the Russell microcap index. So that's getting to be about as small as we'll go generally.
I want to see the list. I'm sure somebody has a list published somewhere, So if you're seeing this on Twitter or listening in, hit me up, send it on over. I'd love to see that. That would be super interesting.
Yeah.
Right. I mean, I'm sure you guys have a list somewhere. I mean, I don't know. I feel like we've covered quite a bit already. I don't know. It's not rocket science, but it's also a fun game to play here. And when you're, potentially looking at new ideas or evaluating your own portfolio, seeing how, your company's, your portfolio is performing based compared to the Russell. And I mean, is there anything we missed or other things that
yeah. The only thing I would emphasize is, we talked a lot about like new names around this, but we own companies for 3, 5, 10 years, like I was saying, and that can create interesting trading opportunities for companies that folks might have in their portfolio already. So like, we own this current company, which is a test and measurement company, and we bought it in 2019 around $4. it got added to the index in 2020. The stock went up to 12, and then it stumbled in 2021 and 2022 with supply chain, so it went back to 4, and now it's started sorting itself out and doing well, and it's back about 10. And so, like, we've liked the company all 4 or 5 years, and we understood the challenges we're going throughout it. But it's helpful in my mind just to know like what non-fundamental buying pressure and selling pressure going to be occurring to your existing names as well as new ideas. And the same thing can be applied in my mind.
Very cool. All right, I think we're there, man. So Paul, where can our audience go and find more information on you, get in touch with you, as well as Punch and Associates?
Yeah, so the Punch Associates website is www.punchinvest.com. You can find me on Twitter at Paul T. Dwyer, and those are probably the 2 easiest ways to get a hold of me. But certainly appreciate your time today, Bobby. Thanks for the opportunity.
No, Paul, thank you, man. I really do appreciate it. Good luck. Stay safe. And I look forward to the next time we chat. Hopefully not a full year from now, but, yeah, we'll see how we're doing maybe towards the end of the year.
Sounds good. Thanks, Bobby.
Thank you. Podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.